Hey folks, David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis. Today is Monday, July 20, 2015. And what I've got up here now is a daily chart of the E-mini contract. And I'm going to flip back and forth between the E-mini and the spider. So first we'll talk about the E-mini. So where are we? Let's just recap from the last few weeks, just real quick, and then we'll bring it up to date and go moving forward. So a couple of weeks ago, we were down here. I said, we're going to get one more rally. It's just a matter of whether we get it from down in this area here. And I kept drawing the X, saying this was the downside, possibility. But if we got above the neckline of the head and shoulders, and this is kind of why I left it in here, then we were going to see a rally and maybe new highs, but I wasn't sure. I was kind of suspect we would see new highs. And that's what happened. We're kind of hovering around new highs. We didn't make it today, but that doesn't mean we can't get new highs. And it really doesn't matter at this point. And this is why I kind of wanted to lead up to this. It makes no difference whether we make new highs or not, whether it's by 5 points or 10 points or 2 points. It doesn't matter, because what's inevitable is the market's going to turn again. We're in the window of, I'll call it the window of opportunity for the next turn. And that could be any time between now and let's just say the end of July. So we've got a week or so, maybe 10 days tops, something like that, where the market could certainly hover around, make new highs, spike higher. We could get significant new highs. We just don't know. And that's the reason why I began explaining last week that we're not going to take a short position in the market up until the point when the market gives us the signal. It didn't give us the signal today, although let me show you intraday what did happen towards the end of the day. Okay, and you've heard me say many times, it's not how they trade them, it's how they close them. And what happened today was they didn't close them well. They closed them poorly. So as you can see, the last 40 minutes of the day, roughly, or more, when did it roll over? Yeah, we rolled over about 20 after 3. And basically that's telling you that there is weakness out there, but that's not to say we can't go up again tomorrow. And one of the catalysts can and may be Apple. As crazy as it sounds, one stock can be a catalyst in the market, and Apple reports earnings after the bell tomorrow. So what I'll tell you now is that I will be selling a position in Apple tomorrow, because I'm not going to play it into earnings, because just the same as we saw a run-up in Google after earnings, we could see the same or opposite in Apple, and I'm not going to give up those profits. So that pretty much takes care of that. So anybody long Apple, just be aware that earnings are after the close tomorrow. Therefore, you have to be cognizant of the fact that anything can happen, and there's just no way to tell which way it's going to go. It could be up by $10, it could be down by $10, or less or more. There's just no way to know. So playing it into earnings, holding it into earnings is really more of a gamble than anything else. But that's up to the individual investor, and we'll leave it at that. So it's how they close them, and they closed them poorly today. Let me show you something else. Well, then I'm going to show you the spider, because I have something on the spider. So the VIX was hovering. It was really, really low today. We hit that 15.5 number, the 11.5 number that I was telling you about. At 11:30 today, we were 11:51. I was saying we're going to get down to about 11:50, and look what happened. We went higher and closed at about 12:20, and it just went a little bit lower than that as I speak now. But again, we have to wait for the market signal. We're waiting for some kind of a topping tail, a high volume reversal day, anything in between. I'll know it when I see it. I always do, but we have to see it first. So what that tells me, or what should tell you, is I'm not trying to top tick the market. I'm not trying to get the last tick in the market to short. It's virtually impossible to do that. When you do that, it's more luck than anything else. And the reason is because there's no way to tell the market is topping up until it tops. Other than that, it's really just a guess. And that's why I suggest we wait for the market to tell us. There'll be plenty of downside to be had. You don't have to get the last tick, just like you don't have to get the last tick at the bottom. And just to support that case, let's go back to the daily chart of the ES contract, okay? And let me just explain this. It's very, very important, all right? If you look at the daily chart, and let's say you weren't a buyer down here because it could have went either way. Could have went down here or it could have went up here. And you waited until we had a close above this level here, or it looked like we were going to close above this level. So this day here was certainly going to close above the neckline, and you hopped on. So you didn't get the whole thing, but you still made money. So I would rather make money with a higher probability than more risk. And that's basically what it boils down to. So if I bought down here and the market continued down, I would have felt pretty bad about it. But so I make less money with a higher probability in the end. And that's fine with me. When you do that time and time again, you minimize your losses greatly. And while your gains may not be the tremendous gain that if you had from the absolute low at 2035, but you still had a nice gain nevertheless. And guess what? When the market does top out, and we know it topped out, so we get it at 2110, 2115, 2105, and maybe we ride it back down to this level or lower. And that's kind of what I'm looking at, and that's what I'm trying to explain here. So hopefully that's helpful, folks. Let's go over to the spider before we leave the S&P. And I want to show you something that's also equally important. So I'm going to blow this up a little bit. Okay, the other way. And see, what I want to show you is I'm going to draw a trend line in from the high, okay, back in May, June, okay, through the high in June. Oh, so this high was in, bear with me, this high was in May, this high was in June. So I'm just connecting the tops, and look what happened today. The trend line that was drawn in, not by me, but the market, because of these two tops, the market is drawing this trend line, and it's telling you that this is resistance. So that's why I was saying to you that 212 to 213 is going to be resistance. I knew this line ahead of time, but I'm showing it to you now, and we pierced through it and closed below it today. What it doesn't tell me whether the market's going to go up or down tomorrow, but what it does tell me is that I'm right in that this area certainly is resistance, because you can see how the market slowed. Once we got to 212, the volume dried out, the market certainly went up slower and much less than these days here. We had bigger up days, gap higher. And then here, the market pierces through to 213 and backs off. So I'm not saying we can't go higher. We certainly can. We can make new highs. And even way back when, I was saying that the last rally may be a blow-off top and it may take us to new highs. And it still may. But I don't really care what happens, whether we do make or do not make new highs. What I care about is identifying the top. Now today, some will consider this somewhat of a topping signal. It's something like a doji candle. It's a narrow bar, a narrow candle, and that could be the first or earliest sign of a topping signal, but it wasn't on any volume. So as far as I'm concerned, it's not a topping signal. I need more. The whole volume today was only 65 or 66 million shares in the spider, and that's a very light day. Right now, your last 90 days average is 108 or 9 million shares. Today we do 66, 67, or 66 million shares. That's not going to cut it. You're going to have to see a higher volume reversal day for it to be meaningful. So hopefully that gives you the total picture in the spider and the total picture in the S&P and what I'm looking at on the markets. And now we can move on because we have some juicy stuff in gold, right? Last night, gold collapses, okay? Collapsed in late last night at, what was it, like, I don't know, 8, 9 o'clock at night, whatever that was. And we went all the way down, and get this number, down to 1180, I think it was, right? The low was 1080, forgive me, 1080. Now, I gave you last week, and the week before, I gave you the downside target of 1075. So here's the predicament we're in, okay? Let's go to the intraday and we'll go to the hourly chart and just see what happened here. So here's that spike lower last night, and then we begin to bounce off that low and kind of work off some of that oversold condition, and then it failed again today. Now here's what I'm looking at, and I did get a number of emails today. Is it time to buy gold? Should I buy GDX? All this stuff. Not yet, and here's the reason why. Because just like the stock market, we need to see the signal that gold is bottoming. Again, we may or may not catch the low, and I'm fine with that, but the fact that we didn't get to 1075, and remember, this is a mathematical level for me. I calculate this level, and it's within the margin of error, yes, because it was such a hard and fast spike. It could have went either way, more or less than 1075, but I always am suspect that we're still going to see either a retest of 1080, which could come short of 1080 or at 1080, or we go all the way down to 1075. So I'm not ready to call a bottom, and it's certainly not going to be, by the way, I don't think a long-term bottom in gold. I think there are lower prices, but that doesn't mean that we can't see higher prices first. Nothing goes in a straight line, you know that. But all this being said, I'm not sold that it was a low yet. I still like to see my mathematical levels touched or satisfied, and the fact that it wasn't, and yes, it was in the margin of error or within the margin of error, but not satisfied. So at this point, I'm not satisfied myself that gold is finished going lower. Can it go higher? Of course it can. Could we see higher prices by the end of the week? Of course we can. But I would have felt a lot better, and I'll give you this. It's not a secret, but I'll give you this here. If we stayed inside this level here, it shouldn't be a squiggly line, but it is. In fact, let me do one better for you. I'll draw a better trend line in. If we stayed above, if we stayed above the low of this candle, okay, and this was still, I believe, last night. Yeah, it was 3 o'clock in the morning. If we stayed above this bottom end of this candle here, which was at 1107.20, then I would feel better about this holding and than the possibility of higher prices. But the fact that we broke lower than this today tells me that gold's not out of the woods yet. So again, we work on probabilities. We work on the highest probability thing unfolding. And right now, the highest probability thing unfolding isn't clear to me. I can say, I can build a case either way, that maybe we see higher prices, maybe we see a retest of 1080, and maybe we see 1075 satisfied. So all that being said, I'm not interested in going long gold just yet. There will come a time, but that should give you at least the picture that I am looking at for gold, and there you have it. So by the way, no way did I expect gold to do the entire 1075, give or take, in one shot like we did last night. I did have the number, but for us to see it all in one shot, not so much. But if you remember from whether it was Thursday and Friday or just Friday's video, I indicated to everybody that you could go short gold, and that turned out to be right. And I'm not playing Monday morning quarterback. I'm just saying that the picture was pretty clear that we were not going to regain 1155 up here, and that lower prices were coming, and that did work out to be the case. You can see once we started to melt away from 1155 and we hit 1130, and that's when I started telling you that, gold's going lower and you can be short gold, but I didn't like the fact that the stop, I didn't like a stop at 1155, and I indicated to that on Friday as well. But certainly the writing was on the wall, and the writing was put on the wall. It was there, and we certainly went lower all in one fell swoop. So, okay, that's enough in gold. I'll keep you in the loop on that, of course. Gold miners, of course, that got taken out behind the woodshed. But interestingly enough, as you look at the gold miners, This, okay, is not a reversal day, but this is maybe a capitulation day. You have high volume, 160 million shares against 33 to 34 million share average. Okay, and so that's definitely a high volume, wide range day, right? We had a huge down day. This could be considered a capitulation or an exhaustion day in the gold miners. So there may not be that much more downside in gold miners. So if we see a retest of 1080, or 1075 down to the target in gold, you may actually see the gold miners trade the other way or stay flat while that's happening. That would be your earliest, first, and good indication that gold is bottoming for the short term, and there may be a trade at hand in gold or both the gold miners. So hopefully that's helpful also for those of you that are looking to enter the gold miners, and I know some of you are from the emails I've gotten, and that's fine. I get it. I know, because what happens is once the gold miners begin to rally, you can have a 20, 25, 30% rally before anybody realizes they're rallying. So I totally understand it. But you can see here, trying to pick a bottom was a fool's game. You've got to let the market tell you what to do. And this was the first and earliest indication that we may have seen exhaustion or capitulation today. All right, let's move on. Oil. Oil is telling an interesting story. It's telling the story that I've been telling for several days or even a couple of weeks. If you recall, let's go to the trusty tool here. If you recall, bearish pattern is playing out, okay? So where are the downside targets? The downside targets remain the same from what I've told you last week. The downside target number one is very, very nearby. And what was our low today before I get to the downside target? Yeah, 49.85. First downside target is $49.50. And here's the way that works. If we hold, meaning we get to 49.50, and that's give or take the margin of error. It could be 20 cents, 10 cents, 30 cents. That's certainly possible. But what I'm looking for is it's got to close hourly over or below 49.50 to tell the next story. The next story would be 49.50 close below hourly and then daily, and we're probably looking at 45, give or take. Hourly close above 49.50 and then daily close above 49.50. And that may be a shorter term low, and we could probably see a move up of maybe I'm going to say, and I haven't worked out the number, I can't work out a number until I see the low, but I'm going to say it would probably be good for $3 to $3.50 on the upside. And that's a function of A, mathematics, and B, what would be at the time a very oversold condition, and you would typically get a pretty good snapback because you'll get some bargain hunters and you'll get some short covering all at the same time, and that would send oil up in pretty fast fashion. But we're not there yet. We've got to see those conditions present themselves before that takes place. So that gives you the bookends in oil. Below 49.50, above 49.50, it's pretty cut and dry. In fact, I'm going to put a line in, which you won't be able to see on the chart because it's too low, but we'll put it in at 49.50, and this will be our, oh, there it is, good. And this will be our line in the sand. In fact, what I'm going to do is put a line in the sand, and we'll make it red, and we'll make it thicker, and that will be our line in the sand for the time being. And that should serve us well. So that's the story in oil. So we're doing pretty well. Actually, the markets are doing exactly what we've discussed they should or would or will do. So things are working out. And by the way, whether it's the stock market, oil, gold, when things begin to work, and bonds too, which we'll talk about in a second, but they're working out just the same. When that happens, what it tells me is that my turn dates are working, which means that I gain more confidence than normal in the turn dates, when they work out, one after the other, it tells me that the cycle turns are converging, and a lot of the markets altogether are reacting to the converging cycles. And whether that sounds confusing or not, I apologize, but all you need to know is it tells us that we have confidence that we're right. It's just that simple. We're not always right, but when we're right, we're right, and that's the bottom line. So let's go to bonds, and the TLT, which is the ETF proxy that we use for the bond market. As you can see, we were looking for a run-up to the 50-period moving average from down here. We got that. We backed off today, and my indication and my feeling, and I don't have, I can't tell you it's going to reach the 20 moving average tomorrow or Wednesday, but what I can tell you is there's a high probability that there's a little bit lower prices coming in the bond market, and I'm going to use the 20 period moving average here, which is the red line, which would bring us down about another $1 as the first stopping point for now. But as you can see, and we've discussed this for a while, we're in a range. The range is down here at 1543 and 1850 to 1875, where I told you the 50-period moving average was sloping down, and at the time we reached 1875, and then we went back into the channel, and that's where we are. So we're in a range, and we're at the closer to the top end of the range now, so there's no reason that I can see to be long bonds right now. Whether you want to be short bonds, I'm not sure that's a smart move. I don't know how much is on the downside in our immediate future, but if you do play bond futures, then that may be a different story, because there's more in it as the leverage plays in your favor. Even a few ticks down could be a nice trade if we got to the 20-period moving average. So $1 in the TLT doesn't have the same meaning to somebody that's trading the bond futures. I'll give you the example. So right here, let's say we came down to 150 from 151.24. That's a much bigger gain in bond futures than the TLT would provide being short the TLT. So that just tells you why I said that. That's all. But again, this is working out just the way it was supposed to, and everybody should be comfortable that the markets are reacting positively to the way I'm reading them. So we're all doing well. We're all on the same page. The dollar continues higher. We're continuing the march to 98.60 possibly. That's the next upside target that I had after 97.75. And if you remember, we came short of 97.75, came back down to the 96.15, and then we marched higher again, and here we go. So now, once we reach and achieve target A or the first target, then there's always another target. So the market moves in stair steps. They're all the same. So once you get target 1, then we're able to calculate another target, or I'm able to provide you another target, and that's the way the market works. So if and when the market does get up, the dollar does get up to 98.60, most likely, at the very least, on a daily basis, would stall there for at minimum of a day or so, similar to what happened in this area here, and similar to what happens here, where we stall, we hit or miss a target, and then we stall out, then we try it again, or we just come back down. So we'll see what happens, but right now the dollar is attempting 98.60. That's the only number I really have to provide you on the upside. Okay. Next market, which is natural gas. So natural gas did exactly what I said it would do, which was it ran up, and then we pulled back, and we finally hit the 20-period moving average today, and it reacted off that by rallying slightly, well, not slightly, but off the 20-period moving average, and that was expected. It's kind of, I think I said it either Thursday or Friday, or Thursday and Friday of last week. So again, natural gas, bonds, the dollar, the stock market, gold, oil, it's almost like the perfect storm. It gives me confidence that whatever I'm telling you is more right than normal. That's all I'm saying. I have a lot of confidence that 75-80% of the time we're going to be right. Right now, I have a high level of confidence that everything I'm telling you is playing out, well, everything I'm telling you is playing out the way it's supposed to. Therefore, we should be in good shape moving forward. We just need to wait. And just as a wrap, let's go to the stock market. As a wrap, I'm going to tell you that whether we make new highs or not, I am very, very confident that within, not in the next 2 weeks, but within the next 2 weeks, we're going to see the market roll over, and there's going to be a wonderful opportunity on the downside for the stock market. So just know that it's coming. We just have to be patient and let the market show us its hand. That's all we're looking for. Before we go tonight, I'm going to look at Apple with you, because Apple's going to report earnings tomorrow, and you can see I have these lines in here that I've shown you before, and the fact that we got above this trend line, once it got above that trend line, we were going to 130 or higher, and we're higher, but it stalled out today a little bit. And as you can see, if I look at the shorter time frame, the 10-minute chart, you could see what happened. We grinded higher, okay, and we rolled over at the end of the day. Now, did Apple roll over first and then the market rolled over, or vice versa? It doesn't really matter. What matters is that this is the first sign that everything isn't as healthy as everybody would like to believe it is. Last thing, I almost forgot. I wanted to show you one more thing. So last item today is the IWM. While the S&P was up today slightly, and the Dow was up slightly, and the NASDAQ was up slightly, the IWM was down all day. And what that tells you is, and you know this, I've said this a number of times, when the small cap index, which is risk assets, and the NASDAQ index is not leading the markets, that tells you, it tells me, it tells all of us that the risk assets are not leading the market, which tells me that everything is not as healthy as they would like it to believe. And who is they? The folks on TV that tell you, this is going higher for another whatever period of time, and blah blah blah. So all in all, I've given you a lot of data tonight. But the point I want to make is, all we have to do is wait for the market to show its hand. That's the next move. Trim your longs, protect your longs, and we're waiting for the next move in the market. With that, I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.